This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. Welcome to Bazaar Morning Call. We're live from the CNBC-TV18 Motilal Oswal studio in Mumbai. I'm Sonia, and as always with me is Lata and Nigel. Thanks a lot for tuning in this morning. We wake up to mildly positive cues across the global markets. So the SGX Nifty is indicating a mild up move, and the US markets as well mildly in the green. But the investors are busy digesting the Fed minutes, which indicates that there could be higher rates ahead for some more time. A lot of the data that came through, and there's plenty coming through this week, the US job openings, the labor turnover report was quite strong, indicating that perhaps there are more rate hikes possible. But in our own markets, there was large selling that resumed once again from the FI community. So FI sold over 2,600 crores. There was a big gash in trade yesterday, and a lot of short positions opening up in key names, whether it's names like Infosys. There was long unwinding in banking names despite good numbers coming through. So Bank of Baroda, PNB, etc. seeing long unwinding. A couple of levels to watch on the index. Perhaps important to see if the Nifty holds on to the 23rd December lows, which was around 17,800. And the near-term resistance is around 18,300 to 18,600. Remember, the recent peak which we hit on 14 December was 18,660. So I'm watching out for this range, 18,000 to 18,300 or so. A lot of data coming through. There's the non-farm payroll, the hourly wages, the unemployment rate on Friday. So we'll be tracking all of that closely. Lata, Nigel, good morning. It looks like, yesterday we were speaking about this as to how the trend is more on the downside, and that seems to be the case.
Well, I'll have to see. Maybe today it could be different. Just to repeat what you said about the Fed minutes, there was unmistakable hawkishness. But for the markets, it was what they had expected. It was all more hawkish than what they thought. I was just wanting to put on the table this one sentence which seemed to indicate that they are worried about the unwarranted expectation of looseness in the market. The fact that if you looked at the CME Fed Watch tool, the Fed futures, they are still pricing in cuts. And that seems to worry the Fed officials, because they point out that our policies work only if they work through the financial markets. And the financial markets are pricing in something which we don't have in our mind, then we have a problem. They're clearly stating that. And, we will have experts to parse this thought process of the Fed. I'm just worried about that the market is going to price in cuts, then I have to indicate more hawkishness. That seems to be their worry, which perhaps they don't want to do, but the market is forcing their hand. The markets, of course, have risen because they were positioned for 2 days of fall after the US markets fell in the past 2 days. So we must not take away too much from the fact that the markets recovered. They may still digest something more in the days to come. For me, I think the bigger positive is the way the crude market has gone. I mean, at $78, it's a huge fall, and they are pricing in clearly a huge global recession. And, there'll be geopolitics. Where does Russia figure? We'll be less dependent on Russia if crude falls anyway. So this becomes very important for India. And the fact that the US yield market also did not react. So that also means the cost of capital is coming down. Both those are EM positive, India positive in particular. And I would agree with you that there is a big worry about the way the FPIs are selling. Look at the number. It's not just selling. It's 2,620 crores. And I was just counting going back from Feb 27th, every single day they have sold. When the market volume is low, they've sold 3 digits. When the market has resumed full activity, they're selling 4 digits.
You mean December 27th?
December 27th.
You said Feb 27th?
Sorry. Okay, from December 27th, they have been selling. And that, I think, is a bit worrying, that there is a relentlessness about the selling. And of course, as you pointed out, we will have to remain cautious till the payrolls. Otherwise, for me, the net today is actually positive, because I think crude overwhelms everything.
Okay, all right. The FIs, they have been bearish. Normally, market commentators, analysts, they'll try to hedge themselves, but the FIs haven't. There's only one way to put it. The data points that are coming in yesterday are bearish from the FIs, whether it's in the cash
so more
market
shorts,
or the FNO market. I'll explain that in just a bit. The question is, will they get stumped on the wrong side? Is there, in cricketing parlance, is there a dusra that's coming? Because they have gone all in yesterday on the short side. The Nifty is likely to open up in the green, but building on from there is going to be very, very important. Let's explain the FI and the cash market first. The institutional number, well, that's a net sell number. That's the FI and the DI number put it together, close to 1,900 crores. We haven't seen a sell number like this all the way since October. The FIs, in the last 9 sessions, they've sold 10,000 crores, 9,900 crores or thereabouts. What do they do in the F&O market? Well, the FIs, they added short positions. Close to 22,000 short positions is what they've added, with the short positioning now moving to around 64%. On the index option side as well, they bought puts and they wrote calls. And they wrote calls very, very aggressively yesterday. So let's pull up 3 strikes, the 18,100, 18,150 and the 18,200 call. These expire today. They've written, calls out there. The total is close to 2 crore shares odd. And because of such aggressive call writing, the PCR that was more than 1, it's come down to around 0.7 odd. Now, this is not such a bad thing. If we can hold on to the morning gains, you get an intraday dip and buy into, you will be forced to see a big short covering bounce that could play out in the near term. So the crucial levels, 17,900, why that's important? Because the 18,000 put has the highest open interest. Also at 17,900, you have the 100 DMA. So that becomes a very, very crucial line in the sand level, 17,900, 17,950. On the upside, in the last 2 sessions, they've gone to 18,250 and got rejected. So that becomes a very, very important resistance level as well. The SGX Nifty suggesting a bit of a green start. My guess is at some point of time, you'll get a bit of an intraday dip. And risk reward could favor you, provided we hold onto that 17,950 odd mark. It's weekly expiry as well, so volatility will pick up in the final hour of trade. So just keep an eye out on that mark. FIs bearish, may not be such a bad thing. Will they get stuck on the wrong side?
Yeah, so if there is a bounce, then we get a very good bounce if there are so many shots. All right, we will of course discuss all this with guests, but therefore let me tell you what is lined up in the first half hour of the show today. First up, we will get you updates from the global markets, and Richard Harris of Port Shelter Investment Management and Robert Sorkin of Citi will be with us to discuss the global trade setup. Later, our research team will bring you CNBC-TV18's list of top 10 stocks that you should keep on your radar. And at around 8:30 a.m., we will do a fundamental stock analysis check with Nishchal Maheshwari of Centrum Broking.
Right. Well, there is definitely a risk-off sentiment on Dalal Street, something we've seen in the last few days, and foreign investors are back to selling in a big way. So let's get you some opinion on how to approach the markets today. On the equities front, Gautam Dugar of Motilal Oswal Financial expects a narrow, range-bound market till earnings season starts next week. He says they like financials, IT and consumer stocks. He says the near-term risk is the overall economic slowdown, as the RBI is projecting a 4.5% GDP growth in the second half of the fiscal, which is a fairly slow pace of growth. Other global challenges around higher rates, geopolitics and commodities could keep a lid on the market gains. However, they are not expecting any sharp fall unless we get ugly results this season.
Got that. Okay, now let's get your money market views. Parul Mittal of Standard Chartered says the dollar INR moved higher to hit the 83 threshold this week, while lower oil prices and central bank intervention capped the up move. She expects the dollar-rupee pair to trade in a range of 82.60 to 83.10 for this week. Adds that she expects the rupee to continue to underperform global peers in 2023 as trade deficit remains elevated.
Okay, and on the bonds, Parul Mittal Sinha says the domestic yields traded range-bound last week despite a downward correction in global yields. She expects the 10-year benchmark to trade in a range of 7.25 to 7.35% next week, with an eye on the December CPI. Also, the market's focus is primarily on the recent forex volatility and the FY24 budget on the 1st of February.
Okay, so those are all the domestic cues, and now let's invite our global experts to parse the FOMC minutes. Joining us is Richard Harris, the Chief Executive at Port Shelter Investment Management, and Robert Sorkin, the Global Economist at Citi. Gentlemen, thank you very much for joining us. Robert, thank you for staying up for us. Let me start with you, Richard. How would you parse what the Fed had to say?
Well, I think that we're in a situation at the moment where the Fed actually wants to be a friend to everybody. They're not really coming up with anything definite. And I think analysts really have to take their own counsel from this and look at the evidence. You know, the Fed has blown hot and cold. We are seeing inflation coming down. But the bottom line is that if the Fed increase, they are likely to bring on a recession. If they cut rates for any reason, they are likely to have inflation running out of control. And if they keep things as they are, or let's assume we're in the Goldilocks position now, we still have inflation and interest rates that are going to remain stubbornly well above what we've seen over the last 10 years. So I think the impact on Main Street this year is going to be quite difficult. So the Fed, I think, is going to blow hot and cold. It's going to be very difficult to get any signs, real signs from them. And I think analysts just have to look at the evidence.
Robert, I was particularly puzzled by that statement on, the perception of the market. They explained that, the Fed can work only if the policy works through the market, and therefore this pricing in of cuts appears to disturb them. How should we understand it? Therefore, will they be even more hawkish than what the dot chart told us in December?
Thanks so much for having me. That's a great question. And I think what the Fed was trying to accomplish there is that they're clearly becoming uncomfortable with the level of market pricing that they've seen in recent weeks and months of underestimating how far the Fed is willing to go to bring inflation back down to target, underestimating how long they're willing to hold their policy rate once they stop hiking in the cycle, and overestimating their desire to cut quickly at any signs that inflation is showing signs of decelerating. What the Fed really wants to emphasize is that even though they have a dual mandate of employment and inflation, getting inflation back to target is job number one, and that they're willing to bear a growth cost to bring inflation down. And if that includes a recession, I think that's what's likely to happen. And that they want financial conditions to tighten appropriately, because if they don't, it makes their job even harder because, as you noted earlier, monetary policy plays through the system by first tightening financial conditions, then playing through into the real economy. If the market doesn't believe that they're committed to bringing policy rates above 5%, if markets don't believe that the risks are to the upside, that policy rate has to go even higher, and if markets don't believe that they're going to hold that rate for a material period of time next year, that makes their job a lot harder, and that goes against their fight against inflation.
Okay, so what's the strategy, Richard, now with markets like India? Because there's definitely a slowdown in growth. The projections here as well are about 4.5% GDP growth for the second half of the year. There's earnings slowdown that people are looking at as well. Do you raise cash levels? Do you move to asset classes like gold? Because gold has been doing very well too. What's the approach?
Well, it's always difficult because markets move in sudden jumps. From what we're seeing, I mean, both of us seem to agree that the Fed is probably not going to stay here. And when markets realize that, I think they're going to have a big fall. Markets move in sudden jumps. However, we analysts don't like to make those sudden jumps as well, because we could be completely wrong. However, I think it's very important to be cautious. I think this is a year when you can't run, you can't hide. We don't know if there's going to be a big fall, when there's going to be a big fall, as markets take on these more negative issues that have sort of disappeared over the last quarter. So I think it is quite difficult. But I think investors do need to be cautious. They do need to be aware that if we do see inflation, some companies are going to be hit, and other companies like consumer staples will probably be able to keep ticking their prices up. I still think the tech sector has a lot going for it, because if people are looking to cut costs, they're probably going to invest into tech. Yes, we've seen a big fall, and that may still continue a little bit. But I think that if you're looking longer term and you want to look over the valley, then tech is one sector you shouldn't ignore.
Okay, all right. Hi, Richard. Morning. What about the toss-up between India and China? In the past, you've said you're not really convinced. Data points that are coming out there, they're not convincing enough for you to look at China. But what's your sense now at these valuations, post the underperformance that China has seen? Will you give it a look?
Yeah. Well, that's a good question, because you're right. I think last time we spoke, China hadn't really come out of its COVID lockdown. Now they've gone from one end to the other almost. And I think that if you're looking tactically, then I think China and maybe even Hong Kong as an option on China actually look very good on a tactical basis. And if you look at what happened to the US and Europe when they came out of lockdown, we had a huge amount of revenge spending. So I think we'll see growth without the Chinese authorities even trying very hard. But that will be tactical. And that will probably outperform other markets, I would say, for the next quarter, maybe the next 2 quarters. But after that, China still has to figure that whatever the world does, that's going to happen to China. You know, China cannot outgrow the world anymore. It's just too big for that. And I think that views of people thinking that Chinese growth are going to go back to where they were previously, I think they're way out of line. So the bottom line is that, yes, China looks very interesting tactically, probably one of the best, brightest areas in the investment spectrum you can see at the moment. But sooner or later, they'll come into line. The revenge buying will slow down, and China will come back into line with other markets.
Okay. Yeah, I don't think I've seen a GDP forecast above 5% even for China. So I guess people are not penciling in too much there, but clearly attractive prices. Robert, what should we make of US bond yields and the currency? Do you think the dollar index doesn't go up anymore? It's headed down, and therefore, can EM currencies like India at least rest that further depreciation is not in order?
I think starting on the yield side, I think what we saw last year was that the yield curve got a bit too inverted if you look at the 2s, 10s yields, particularly on the 10 side. I think the 10s got a bit too low towards the end of last year. You've seen some of that reverse in recent weeks. And we put out a piece where we think the 2s, 10s inversion will average about 60 basis points over the next several months, and then start to steepen in earnest once the Fed pauses its policy path. So I think, you know, from here, you're probably looking at, you know, similar rates going forward, potentially maybe a little more upside in the 10-year yield in the short term. But that's kind of how we see the spread of the curve over the next several months. On the dollar side, we think you're probably near points where the dollar is not going to strengthen much further from here. You know, you're getting closer towards the likely end of the Fed hiking cycle. We see another 100 basis points from here. And so we think the dollar is going to stay strong, probably around current levels, maybe a bit stronger in Q1, but then start to depreciate, particularly against other major developed currencies over coming quarters. So I would say the story for the dollar is that we are probably behind peak levels, and that by the end of next year, the currency will likely be a fair amount weaker, and that will allow for adjustment of other currencies, major DM and also major EM currencies to appreciate relative to the dollar.
Okay, one final question then, a very short one at that, Richard. Do you see a major global correction coming, especially in markets like India or emerging markets? Or is this just a painful time correction that we will have to endure?
Well, I think the concern that we have to look at this year is last year was a horrendous one. If you look at the numbers on the financial markets, on Wall Street, if you like, you know, we had both equities and bonds going down in a way we have never seen in decades, maybe even in 100 years. However, I think that Wall Street, the concerns are going to move into Main Street. When they move into Main Street, more unemployment because people are looking at cutting costs, reducing earnings because people are looking at cutting costs. I don't see really a lot of outcome for growth, and I suspect that we may see some more stress on Main Street this year rather than Wall Street. And of course, that will have an impact on the financial markets.
Okay. Yes, it will. We just want to know how much should we buckle our seats for. Thank you very much, Richard Harris and Robert Sorkin, Robert Sorkin for waiting up for us, and Richard Harris for sparing time with us. Thank you very much.
Thank you.
Thank you.
Okay, so as you can see, everyone's asking us to put on our seatbelts. It looks like it's going to be a rocky ride. But let's see if we can get more advantage because of the crude price fall. Quick break now, and then our team will be with us to list the top 10 stocks.
Welcome back. Hope you're having a good morning so far. There is definitely risk-off on the Lal Street, something that we saw yesterday, large selling from foreign investors as well. But this morning, the picture is a bit different. We could perhaps see a bit of a recovery. Whether that gets sold into, only time will tell, but there's definitely caution on the street. Let's get straight to individual stocks then. Abhishek is joining in first up to tell us about Bajaj Finance and why he's watching that one. Abhishek, over to you.
Well, Sonia, business update has come in from Bajaj Finance. Fabulous customer growth. However, AUM growth has actually moderated a bit but remains strong. So new loans are at all-time high on a quarterly basis, coming in at 78 lakhs, up about 14.7% sequentially. The customer base is strong, growing at about 19.1% YOY and about 4.9% sequentially. Q3 historically has been a strong quarter for Bajaj Finance. However, this time the growth rate is on the lower side if you compare to last 3 to 4 years. AUM growth remained healthy at 27.4% YOY and about 5.7% sequentially. This growth rate, however, if you take a look in as per historical trend, is on the lower side in last 4 to 5 quarters. Average ticket size almost flat on a sequential basis. Deposit momentum that continued to remain strong, and capital adequacy ratio has also been strong despite this growth rate. So not much of capital consumed is a good point. Liquidity in the balance sheet has improved on a sequential basis. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, Marico came out with their operational update. Mangalam, how did it look?
Well, it's largely in line with expectations, and what the management has been guiding for as well. They've guided for a mid-single-digit volume growth in the second half of this year, and that's what the companies reported in the third quarter itself. They said that the consolidated revenue grew in low single digits. Gross and operating margins have improved both quarter-on-quarter as well as year-on-year. That was expected too, and as a result of which, there's a modest growth in operating profit. As far as their segments are concerned, Parachute Coconut Oil posted low single-digit volume growth. Saffola franchise grew extremely well, double digits in volume terms, mid-teens in double digits in value terms and mid-teens in volume terms. Value-added hair oils, that's the one which had a subdued quarter, and that's telling you that there is weakness in the rural area and there is strength in urban consumption, which is reflected in the way premium personal care has witnessed a double-digit growth. These numbers, while they're in line, they're no great shakes, So see, no more than a mild green on the stock.
Okay, and we must remember, YOY numbers will look good because they didn't have a very good third quarter last year either. Thanks a lot for that, Mangalam. Abhishek, you said fabulous customer growth for Bajaj Finance. What about RBL Bank?
Well, RBL Bank, it's one of the best loan growth that you are seeing in last 3-4 years. One of the best business update amongst all the banks, and CASA ratio all-time high. So deposit momentum on a YOY basis is the best in last 5 quarters, coming in at 11%, while sequentially the growth of 3% is perhaps the best in 3 quarters. The loan growth coming in at 14% YOY is perhaps the best in 12 quarters, and sequential loan growth of 5.8% is perhaps the best in 15 quarters. So they have gained market share on a sequential basis. The credit to deposit ratio has also improved, which suggests that in a rising interest rate scenario, you could see net interest margin expanding on a sequential basis. CASA ratio, or the low-cost deposit ratio, unlike peers where we have seen declining CASA ratio, the bank has actually reported, improvement in the CASA ratio, and it's at all-time high of 36.6% when compared to 36.2% in the previous quarter. Back to you.
Got that. That's 2 thumbs up for Mr. Subramanya Kumar Iyer, right? Well done. What about MMFSL, Abhishek?
Well, RBI had directed a company to immediately cease their recovery process via outsourcing in September 2022. So this restriction has now been lifted with immediate effect. The restriction has been lifted after the company has informed RBI about the fact that the recovery practices and outsourcing arrangements have changed now, and they have tightened the process of onboarding the third-party agents, which wasn't there earlier. So they have also strengthen the accountability framework as per the board approval. So strengthening of processes has actually helped them in getting approval from RBI on outsourcing of agents. Back to you.
Okay, thanks a lot for that. Well, let's move on. Vivek is tracking some more stocks in the news. Vivek, what do you have for us?
Well, good morning. Quite a few stocks on my radar. First on our list is IRB Infra. The board has approved a stock split in the ratio of 1:10. The board intends to complete this corporate action by the end of February, subject to regulatory approvals. So keep an eye out for Adani Ports as well. The company has released the operational update for the month of December. So the company managed to handle a little over 25 million metric tons of total cargo in December 2022. Container volumes are up 8% on a year-on-year basis. Now, Morgan Stanley has written a note on the back of this operational update. They believe that there is a downside risk to the company's guidance of 350 to 360 million metric tons for FY 2023. The implied ask rate for Q4 is almost a growth of 24% on a year-on-year basis, which at this point of time appears challenging according to them. Also keep an eye out for LJVN, an important development coming in there. The Union Cabinet has approved an investment of a little over 2,600 crore rupees for a hydro project based in Himachal Pradesh. The company has also articulated ambitious plans for addition of capacity. So the company is intending to target 5,000 megawatt capacity by 2023, 25,000 megawatt by 2030, and 50,000 megawatt of hydro power capacity by 2040. Keep an eye out for HPCL as well. The company has forayed into the petrochemical business to pre-market brand polymers and also has entered into an MOU with NTPC to target the renewable energy business.
Okay, all right. Thanks a lot for that, Vivek. Well, Sonia, we got those Class A truck sales as well that flashed. Didn't look too good.
They didn't look too good on the face of it, Nigel. So the numbers, the North American Class A truck orders are down 18% compared to what we saw in the month of September as well as October. And the truck orders are now down 50% from the September high of 56,500. But I went through the website, the ACT and FTR website, and over there, the companies who track these numbers closely, they've said that on the surface, when you combine with the 26% month-on-month decline, it looks weak and might suggest weakening in demand. But what happened is that a lot of the ordering began in September itself. So it began ahead of schedule, which skewed the average now on the upside. So the September orders represented the highest monthly total on record. So we are inclined to view that the December order intake is a solid end to a robust 4 final months of the year. So ordering activity has picked up. It's just that it was front-loaded, in the month of September. That's why December looks a bit weak. So I'm going with a mild red tick, but I don't expect too much weakness because the ordering has been very strong in North America.
Oh, that's very important. One can't make that out when one looks at the numbers. Thanks a lot for that, Sonia. And now for the big cue of the morning. Crude prices down below $80 after a long gap. Manisha, tell us, does it stay there?
Well, this looks like for the very near foreseeable future, yes, at least for the month of January, yes, there could be some more pressure coming in. It is really mild weather across the major consumers like Europe and US, even China for that matter. So the demand has been on the weaker side. So the crude oil prices have declined 10% in last 2 trading sessions. I mean, for 1 year to start like that, and that too January to start like that, has perhaps happened for the first time since 1990. The last time that happened, that you saw this kind of a decline in the month of Jan, in the beginning of year, was at least 3 decades ago. The pressure comes in also because you are looking at higher power generation coming in from wind. The gas storage in Europe and Germany is at 80 to 90%, much above the average of 70% that this time usually sees. So that really weighs on. And then look at the economic data, whether it's the PMI data that we saw from China, which is contracted for a 5th straight month, or US, which is contracted for a 2nd straight month. So the numbers do not give you confidence as well. And not just crude, the gas prices have declined by 25% in last 5 trading sessions itself. So that's also lost a 0.25% of its value in the beginning of January itself, quite unheard of in a very, very long time. Markets also are reacting to the IMF suggesting that there will be slower growth going forward in major consumer countries. So whichever way that you look, the very near term does look slightly on the bearish side. But having said that, most banks and brokerages will tell you that come second quarter, the first half end, you will be back in 3 digits when it comes to the crude oil prices. So well, this month does look bearish, but foreseeable future, Feb, March, April do look bullish when it comes to crude.
Okay, thanks a lot for that. Down 10% in the last 2 sessions alone, a free fall over there in crude.
And she's talking of 3 digits sometime later.
Okay, I guess works well for oil importers like us. But in general, it talks about a slowdown in demand globally, which is not a good thing.
I think OMCs could be in focus today. OMCs,
oh yes, I think green on HPCL.
HPCL, marketing margins will obviously, turn positive.
Yes, and even aviation companies, right? I mean, I'm glad you pointed that out because in any case, the numbers are looking so good on the demand side and now on the cost side side as well.
So aviation, paints, refiners.
And tire companies.
Yes.
Okay. Well, here's a quick recap in case you missed out on any of them. Positive news flow includes names like Bajaj Finance, Marico, RBL Bank, M&M Finance, IRB Infra, SJVN and HPCL. While stocks with negative news flow, Adani Ports, ONGC and Bharat Forge. Take a quick break. Nishchal Maheshwari of Centrum Broking will be with us to do some fundamental analysis. We'll also connect with Jale Rani, the Executive Director at Nuvama Institutional Equities, after the Cabinet approved a national green hydrogen mission. More on that in a bit.
There's yet another big global cue that we will be discussing through the morning, and that is Amazon's announcing that they will cut 18,000 jobs out of a total workforce of 3 lakh. That works out to 6%, as Sonia points out. So that's something that is going to have a sentimental impact. But while speaking about tech stocks, let's get to another tech major. Microsoft chief Satya Nadella is in India, and he spoke to Shireen Bhan. He told her that in the next 2 years, he does expect challenging times for the tech sector. In an exclusive interview with CNBC-TV18, he said that tech companies need to focus on efficiency and productivity to get through this difficult period. Hear him out.
Many CEOs are now talking about having to respond to the new economic reality. What is that going to mean, not just for Microsoft, but for the tech sector in general? Are we likely to see more pain, especially when it comes to retrenching, downsizing, margins going to be under pressure, guidance going to be a downside risk to that as well?
I think overall, quite frankly, whether it's for us as Microsoft or the tech sector, it's going to be very, very important to look inside and say, are we as efficient as we need to be competitive? I mean, at the end of the day, just because we are a technology company doesn't mean that we are the most efficient at what we do. And so as the paradigm has changed, as the bar has risen, we have to measure ourselves with the new bar. So definitely and also the growth picture has changed, we have to have operating expenses that need to be aligned. So definitely we are going to look at all of that, and it means that we are not sort of immune, as I said, to the global changes. But the one interesting thing to your point, though, is tech industry employment is not tech employment.
Yeah.
That, I think, is the key divergence that needs to be well understood, because that, I think, is positive, by the way, for the tech industry long term. Because if you look at it, overall tech jobs has actually increased. The tech jobs now are coming in financial services, in energy companies, in retail, manufacturing, and that's healthy, because in the long run, all those employees in all those industries are going to consume more tech infrastructure, right? When we think about our cloud business, long term we're bullish because of the fact that there's more employment outside of the tech industry of technical talent. And so that's, I think, what we are banking on.
No, I think you underscore the labor market resilience aspect. But, what we've seen, especially as far as the stock markets are concerned, and I know that CEOs often say that don't focus on what the markets are telling you, but they seem to be suggesting that there is significant pain in store for the tech sector. How do you read what's happening with the way that the markets have corrected, specifically the tech stocks, and what that signals?
For me, look, I'm never the one who would ever say ignore the market, because the markets are smarter than us all. I think they are reflecting on is, look, where is the growth coming from? And how should we think about normalizing for that growth? And so I think stock performance, economic performance are not exactly the same. But the key for us as a tech industry, I always go back as a percentage of GDP. The simple question to ask is, do we think tech spend will increase or decrease? If we believe software and digital infrastructure is going to be important in construction, in energy, in manufacturing, long term, then you have to be long on tech industry. But will we have to go through our own cycles around productivity? Absolutely, like anybody else. But that's at least my perspective. I wouldn't look, the only reason why I would say ignore the short term is because in the long run, we would be fine for demand. But in the short run, what we have to focus on is our own productivity and making sure we are at the efficient
How
frontier.
would you quantify short term and long run?
I would say the next 2 years are probably going to be the most challenging because after all, we did have a lot of acceleration during the pandemic, and there is some amount of normalization of that demand. And on top of it, there is a real recession in large parts of the world. And so the combination of pull forward and recession means we will have to adjust. And that'll cycle through the demand cycle and, in fact, come out of it with what can be another massive growth cycle for the tech industry.
Okay, all right. Well, most of the global markets are trading in the green, but let's get stock specific and let's get fundamental analysis going. Nishal Maheshwari, CEO Institutional Equity and Advisory at Centrum Broking, joins us to talk about a whole host of stocks. Hi, Nishal. Good morning. Well, the big cue this morning is that crude oil prices are down. And from an India perspective, well, that's something that we like. But what about sectors? You know, OMCs, there's marketing margins were negative. Now they're moving into the positive trade. Your view on oil marketing companies from here on, given that crude prices are quite weak?
Morning, Nigel. So, yeah, I think basically crude seems to be coming off. And I think that's more to do basically with the outlook, which most of us are now projecting, saying that there is going to be recession in a few large consuming economies of the world in the next year. And I think it's manifesting that. The industry, OMCs itself basically are going to be beneficiaries of that. Historically, we've seen basically that it is difficult in a democracy to keep on taking price rises whenever prices go up and some part of the losses have to be absorbed. But a falling crude price basically is definitely going to be positive for the oil marketing companies. And again, I think India being more diesel and most of the Indian refiners are heavy on diesel. So I think these guys are going to make a good amount of money. So we are positive on the oil marketing company.
Do you have a preference from the three of them?
So we like BPCL, HPCL and IOC in that order.
Okay, BPCL, HPCL and IOC. What are your thoughts on Bajaj Finance and the update that came through? The AUM growth is actually moderating. It's still very strong, but there is some moderation in growth. Any thoughts here?
Morning, Sonia. So what's happening basically in the finance market is basically banks are coming back very, very strongly. So a couple of years, 2 or 3 years of very strong growth of Bajaj Finance was on the back basically that most of the banks were out of the market due to their own problem. So I think NBFCs are facing a challenge from the banks. Banks have definitely a bigger reach. And that's what is manifesting in Bajaj Finance basically at the moment.
Okay. Nishal, we want you to participate in this conversation and we have another guest for this because the big announcement that came from the central government yesterday is that it has approved the National Green Hydrogen Mission and the initial outlay is quite big at 19,700 crore rupees. The mission is targeting investments worth 8 lakh crore, coming from the private sector, and hydrogen production capacity of 5 million metric tons by 2030. We are also joined by Jal Irani, the Executive Director, Nuvama Institutional Equities. Jal, thank you very much for joining in. I'm going to start ulta. First, from what the market should focus on. Would you focus on companies like SJVN, you know, the usual renewable power companies? Would you concentrate on Reliance and the Adani Green companies who are already big in this? From a market perspective, where should we look?
See, the whole new energy opportunity globally itself is at a nascent stage, but potentially humongous. And as we have been now saying several times in the past, India has got the opportunity to become the new energy sort of Middle East of the world. So essentially, I would recommend to focus on the big picture, which is you know how the building blocks are being put into place, and you know why. So the incentives which are being rolled out, whether it's a 20,000 crore green hydrogen mission incentive, or the PLIs in the advanced battery stage, or the solar module PLI, which was already rolled out, is really a function of that India could be very competitive in the space, given its what we call sun and sand advantage, along with the EPC cost, which is half that of even China. So I'd really say top down is the big opportunity to focus on at relatively an early part of the industry. Companies are of course positioning themselves, but it's a rapidly moving jigsaw puzzle.
Okay. Jal, good morning. Due to paucity of time, just wanted to check with you on the potential beneficiaries of this move from a listed standpoint, and who could the indirect beneficiaries be?
Okay, look, we are not going to be talking, at least I'm not going to be talking stocks on this particular so I'll leave that to you to judge.
Okay. All right, Jal, but could you give us a sense about when do you see execution taking place? Now, CAPEX has already been announced, but is the supply chain in place? What's your sense in that?
So, see, again, green hydrogen is part of a much larger chain, and 2/3 the cost of green hydrogen is renewable energy. So the CAPEX spends in the renewable energy space as a key building block has already started with a vengeance. So if you look at the various renewable energy companies, they are almost exclusively setting up only renewable power capacities incrementally. If you look at similarly globally, 60% of all new power capacities are actually in the renewable energy space, and in fact, it's forecast that by 2030, 80% of all incremental capacities will be in the renewable energy space. So it depends on what part of the chain you're talking about. Green hydrogen is sort of midstream to more downstream. So the first part, whether it is solar modules, then solar power, then EPC, all that has already started with a vengeance. Then it filters in now as the rest of the building blocks are being put into place, whether it is green hydrogen, advanced batteries, that's sort of more midstream. Further downstream, and also remember, also to put things into perspective, hydrogen, which is produced from gas or coal today, India is already amongst the largest producers and consumers of grey hydrogen. It's the refineries and chemicals, refineries mainly, which do that. So there is already production of that, and therefore there is a switch which is happening straight away, and that itself, that switch of 5 million tons which is being produced will be an additional renewable energy capacity increase of 115 gigawatts on top of the 350 odd gigawatts, 340 odd gigawatts, which has been targeted by 2030. So the upstream part has already started happening with a vengeance.
Okay. Well, Jal, it's the analogy is very interesting. You are saying that India will be for green hydrogen what the Middle East was for fossil fuels. Now, that's very mouth-watering. By when do you think it fructifies? Does it take all the way up to 2030, or we can see that those things happen earlier?
Well, it's too early for that to happen. See, today the cost of green hydrogen in India is about $4 to $5 a kg. And across the world, it varies. It ranges from at the most cheapest is $2 at the extreme, or $2.50 at the cheapest, to even $10. Now, India's target is to bring down the cost of green hydrogen from $4 or $5 to $1 by 2030. We have done deep analysis, and we feel that $1 by 2030 may be a bit of a stretch, but 1.5 is easily achievable. Now, at 1.5, you've got the potential of being the cheapest in the world in any case, and beyond that, the cost will fall. So, immediate term, I would focus on which industries benefit from green hydrogen, but you need all these incentives and various costs to decline to make it very competitive. So it's a few years away, basically.
Okay, all right, Jal, thank you for stopping by and speaking to us about the green hydrogen mission. Nishal, before we end this discussion, any thoughts from your end on who the potential beneficiaries could be?
So, shortly, I think Jal is an expert there. Basically, he's tracked that sector for 2 decades. So, but what I see, there are a couple of announcements which I can only see. Basically, one is obviously the Adani Group and Reliance. They are the big guys, basically, who are anyway big on the renewable space, and they have announced big investments in that. So we have to see with which company within the Adani Group, and obviously Reliance is the one company. So I think Reliance and Adani Group are the two who will be the beneficiaries there.
Okay. Okay, Nishan, now let's move away from renewable and energy to this stock analysis. Other than Bajaj Finance, the fairly decent number that has hit the exchange list is that of RBL. I mean, RBL was a near broken bank 2 years ago, and this looks like an early turnaround. They've done extremely well on current and savings account. I mean, there were times when people were pulling out deposits, and now they're actually able to attract savings accounts and current accounts. Do you think that stock deserves, merits a look?
Definitely, Lata. I think, as I was saying, I think most of the banks, not most, I think almost all of them have actually got their act together. They have cleaned up their balance sheets. I think most of them have been able to raise capital also. I'm not, don't remember about RBL, but possibly if not, then they will also be able to, because the market is at the moment positive towards the whole banking sector.
Yeah.
And I just see the cycle starting. Actually, for the whole, if you remember from ILFS time, it's been almost 5 years that the whole banking sector, the NBFC sector, all of them have been down. So this is just the starting of the cycle. So I am very favorable towards all banks, especially the smaller ones, because they have a bigger growth potential to go for.
Okay, well, thanks for that. We'll continue talking about stocks, but we need to take a break. On the other side of the break, we'll bring you to the top stock picks of the day from our technical and F&O experts. We'll also decode the stock rally with our Momentumizer segment. At 9:10, Nimesh will be there with the standout brokerage report of the day. And before the markets open in CNBC TV18 Stocks Board, we will highlight the top stocks in the news to focus on for the day. All that coming up in a bit.
Welcome back. We now have our in-house expert to decode the day's market cues for us. Anuj Singhal is waiting by. Anuj, first of all, the market reaction to the Fed was not so bad. And secondly, Nigel was speaking about a huge buildup of shorts in the Indian market. So both those questions.
Yeah, which is good news. Markets rally when FIs sell and when FIs are short. Actually, today is as good a day for, today I'm sticking my neck out and saying that we'll have a massive rally in the market. In fact, the market was positioned for this hawkish Fed, and, I'm a father, and I said, the kids don't do what you tell them. Kids do what you do. So the market is like that. Market will do what Fed does and not what Fed says. And there's a good chance that over 2023, if the data is good, the Fed will at some point cut, even though the minutes say they won't. The market knows that. So in that sense, the Nifty has now tested the lower end of the range. It tested the upper end, failed there. And now at the lower end of the range, and my sense is that it will defend it, because buying near 18,000 and selling near 18,250 is a trade which is working in the market. And as long as the market does not negate that trade, there's no need for traders to preempt that trade. And that's why, that's my sense that it could continue. And in fact, today could be a short squeeze, and Bank Nifty could lead it, because there could be an algo trade today, the way crude prices have fallen and the way bond yields have fallen. Dollar index is also below 104. Though IT stocks could see some pressure because of the statements from Microsoft CEO. So I think that's something that you could keep an eye on. Long short and the Nifty put call ratio also right in the zone from where the markets normally bounce back. If the market has to bounce back, today is the day, and today is the first expiry as well. Levels to watch, the Nifty rejected the 20-day exponential moving average yesterday, but today might see support. 79.67 is the line in sand that I've been talking about. That simply remains your stop loss. I think the Bank Nifty could be the one which could really lead the market today because of this decline in crude prices. And as long as it's holding 42,800, I won't be surprised if it is higher level and in fact reverses most of yesterday's losses. But again, like most things in market, you have to do things with stop losses. And yesterday's low could be an interesting level to look at in that case.
Okay, thanks a lot, Anuj, for that, and have a good day. We'll also track this entire big tech space in the US very closely, right, and the IT space back home as well. Amazon CEO saying that the job cuts will exceed 18,000 roles. That's not a small amount. 6% of their workforce will be laid off. Will definitely have some repercussions in that space. But let's move on. Sudarshan Sukhani, Nitesh Thakkar join in to tell us how to approach the markets today. Sudarshan, good morning. Which way do you think the wind is blowing? I mean, the market had so much pressure yesterday, but do you think the dips could get bought, or are you in general cautious on the market now?
Good morning, Sonia. Well, I'm cautious for the simple reason that yesterday 18,100, because support was broken decisively. The last support now is at 18,000. Now, as the SGX tells us, the markets may actually see a small bounce from here. But whether that bounce is sustainable or not is difficult to say. So overall, I would expect the markets to go significantly lower if they break 18,000. But for the day, that may not happen. Today's trade is a little more difficult. I don't have a view on the direction. Traders should simply open their intraday charts and follow the direction on the charts. That will be much easier than trying to anticipate whether markets will go up or down for the day. There will be a trend today. That trend, the chart will tell us.
Okay, all right. Noted that, Sudarshan. Let's get in Mitesh as well into this discussion. Hi, Mitesh. Morning. Well, what's your thoughts? The FIs have gone net short. All the cues coming in from them are bearish, but we're likely to see a bit of a green start. Chase the opening or buy the dip?
Good morning, Nigel. I think on the index, we haven't been trading much, purely because my view is that it's a range between 18,000 on the downside to roughly about 18,250 on the upside. Now, in the last 3-4 days, we've seen about multiple times the market has gone to 18,250, failed there, and yesterday we saw some kind of a breakdown, but we are yet to see a break of 18,000. So my belief is that this range still remains intact, and therefore, trading with a 30-40 point kind of gap up may not be a very good idea because you'll be somewhere in the middle of the range. Having said that, trading is more stock specific, but my bias is slightly on the downside. If we start breaking 18,000, then I think I'll go aggressively on the short side.
Okay, what about individual stocks then? What are we looking at both on the buy and the sell side? Sudarshan, let me start with you. There were some short positions opened up in Infosys ahead of its earnings. There's a lot of long unwinding in banks as well. What are you looking at?
I'm looking at mid caps, and because I have already said that there is no clear view on the Nifty, it's easier to follow the intraday trend, whichever way it goes. But stocks like Asian Paints, for example, have been in a downtrend of their own. That's an intraday short with a stop above 3,050. Maruti continues to be a buy. It is, moving sideways. It's not doing what the index is doing, not falling. So perhaps there is some momentum on the upside. That's a buy with a stop under 8,300. Navin Fluorine has been in a bear market. Something is going there, which I don't understand, but the charts are very clear. It's heading lower. It's an intraday short with a stop above 4,050. And finally, that outperformer REC continues to be a buy. I think there's significantly more upside. If you can make this into a positional trade, you will be much better off. Stop at 119 and look to buy it.
Okay, all right. Thanks for that, Sudarshan. Mitesh, what about you? Fill us in with your picks.
Yeah, I have 2 buys and 2 sell. On the buying side is National Aluminium. The metals had a good rally and then a pullback. I think Nalco is at a good support area. Could give a bounce to about levels of 85. So buy here with a stop at 79. The other buy call is ICICI Pru Life. That's a buy with a stop below 461 levels. And in the short term, I expect a target of around 480 to about 482 on the upside. Then I have 2 sell calls. Coal India had a massive breakdown yesterday, a very big red candle with a good jump in volumes. That's a sell with a stop at 221.5 for a target of around 208 to begin with. And Grasim, I would want to sell on a mild pullback, say around 1700 odd levels. Start building short positions with a stop at 1720 for targets of 1655.
Okay. Thank you for that, gentlemen. We will, of course, need your help closer to market opening. For the moment, we have to take a break and we're going to come back with the pre-opening rates. We will also be joined by David Lennox of Fat Profits to discuss his 2023 crude outlook now that it has slipped below the $80 mark to $78 per barrel. You don't want to miss that chat.